morning, everybody. Mike Vaki, Princetontrader.com, here for ntmarkets.com with your Friday morning pre-market webcast. Okay, S&P 500 E-mini futures daily chart, and as you can see, we broke out above this 2106 area, 2107 area that had been a problem. The question now becomes, is the breakout going to run, or are we going to go ahead and create a lower high versus yesterday's high at 2114.5 and kind of slip back down to the 9-day simple moving average, the blue line there, down around 2096.5. It's an important day if you are a bull or if you are a bear. The bears need to avoid a big up day today and engagement with the upper Bollinger Band, because if that happens, then you have the potential for an upper band ride into next week. If you are a bull, that's exactly what you want to do. You want to put as much pressure as you possibly can on the bears headed into Sunday night. Next week is a Fed meeting, so you want to continue to, you want that fear of a walk up into the Fed, and that walk up anxiety plays in perfectly to a band ride. Okay, so if you're the bears, you want to avoid that. You want to leave 14.5 as a high, which would be a lower high versus the all-time high on the continuation chart. And you want to get back below some of these key areas. 2106, 2107 is an absolute priority to get below and close below. That has so much potential to be a floor for another leg higher. It's incredible. We haven't seen a floor level this dangerous in a long time coming in so close to the highs. When something is 7-week resistance, tested on multiple occasions since early March, the break above that level and then the subsequent creation of that level of support, that's a floor of floors, and that will be a major problem for the bears if they don't take care of it today or Monday. Not by trading below it. We traded below it last night. That's not good enough. You have to close below it, and you have to turn it back into resistance on a subsequent test. That's asking a lot. But, at the same time, I don't think we're dealing with the bulls of 2013. I've said this before. The bulls of 2013 wouldn't have let anything be 7-week resistance. We maybe would have gone up and tested it once, maybe twice, and then we would have headed above and done a whole other leg higher. We wouldn't even be having this discussion. We would be discussing, when are we ever going to pull back? So those days are gone. This is much more two-sided. The bulls have their moments. The bears have their moments. We've been up for 4 days now. So for the bears to take back control of the tape for a few days is not out of the question. And the starting gun on that is a move below 2106 and then a subsequent move below the 9-day at 96.5. So the ideal for the bears would be a full-blown reversal today, a breakdown, and taking out the 8180 weekly pivot today. I think that's a real reach, but that would be their ideal kind of a day, to get a great big red candle. It's going to be hard to make it an outside day if you're down, but on the downside. But if they can take out some of these lower areas and have some fear going into Sunday night, that's probably the best position they could put themselves in. Okay, everybody have a great day. Follow us on Twitter at Princeton Trader. Check out the website. Come check out the chat room. I love what I do, and I posted a couple things on Twitter yesterday from some of our members that are having some good results and are new to the room, and that's why I do this. So check that stuff out, and if this is something that you trade all the time, come on in. We'd love to meet you, and maybe we can help you with your trading too. So everybody have a fantastic weekend. I'll be back Monday morning with another webcast. Trade them well, everybody.